Okay, so looking into one point through for the PM session, going into Asia. So PM session opens up at 1:30 p.m. after the lunch macro. So 1:30 p.m. opens up. We are going to be looking at the macros in the PM session. So 1:30 opens up. We have the market dropping lower, taking out a short-term low right there. But these fib levels you're having on the chart are this is a daily wick on the daily time frame. This is a daily wick. These are the quadrants drawn. So I'm having the market reaching into top of that daily wick, failing, giving me sell side. So this is, as you can see, this is sell side liquidity right there at that low. To mark that out like this, stand out a bit, takes also. This is lunch macro, sell side liquidity. Okay, so how far can the market go below those lows? We have from the top of the daily wick going into that extrapolated high and low, just like that. So as you can see, I'm having that level target on right there, the negative 0.25. It is hit going into the PM session. So if I'm to expect a move that's going to reverse back into these highs, because this is a lot of liquidity right here. I have these equal highs, relatively equal highs here. So this is cluster liquidity plus this plus that. So this is a lot of liquidity. So I'm expecting the market to take this out for the PM session, going into this high or the first presentation fair value gap, or even back to the 12:30 opening range for yesterday's trading. So we drop down, but where do I want to have my execution at? You all know the optimal trade entry levels when they are inverse. So I'm going to have my fib at that low to this high. And why am I drawing it like that? So on the higher time frame, I expect my breaker to start from this, just because the market has been respecting this specific level. So I expect after the market surpasses this to just continue higher. So this is where I'm going to assume my breaker from on the higher time frame. And for every low that takes out this low, I will be continuing my fib until I get a low that sponsors a move that goes and closes back above those levels. So we have, if I'm to zoom in right there, this is what we have. We have this low. Let me put this off. We have this low that takes out that low. So my fib is at that. We have the market jumping in, tapping encroachment of the daily wick, and it corrects with the volume imbalance. So I'm not considering this as a closure. So I won't consider the market coming back into this as my entry. So we drop lower, forming another low. This low also sponsors a move going into the 0.618, but does not close above. And then we drop and form another low right there. Come back into the 0.79, we do not go above the 0.618. Then that low right there sponsors a move that goes and closes above the 0.618. So anything that comes back into this would be an execution. So just like that. If I'm to zoom in like on a higher time frame, if I'm to zoom in on the higher time frame, where you will see market not being in a fractal, you are going to have something of this sort. This is all noise will drop lower. You see, this is the breakout on the higher time frame. This from that high to that low. So this will drop lower, happen to have a candle closure above that. This week drops down into the 0.79 level. I'm having the next candle using this week as an order block. These are all executions. So this is first entry, second entry, third entry, going into higher prices. So coming back into the 1 minute time frame, want this to stabilize. Coming back into the 1 minute time frame, so that would be my execution right there. So this we close above that, rally higher, drop back into the 0.79. so that this is an entry. This market rallies going into higher prices, just like that. So in these levels, where do I expect the market to rally from? This fair value gap. So I'm having all my executions at that fair value gap right there, not at the 0.618. so many of you are going to say this is a big stop loss, a huge stop loss if you ended on the 0.618, but having the market closing above that, dropping lower into this bullish fair value gap right there. Bullish fair value gap, the market rallies higher, comes back into that one more time. This is entry 2, rallying higher, tapping the 0.618, that is another entry, rallying into consequent approachment of that daily week. So this is the high that gives us break even. The moment it is taken out, your stop loss is at break even right there. So I don't expect the market to come back into this bullish fair value gap. And as you can see right there, we have a move that rallies higher going into this. So this 0, if you're having a fib for the higher time frame, even if it is a lower time frame, this 0 fib level is your first profit scaling. So you're going to take off some contracts or put your stop loss at break even at that point. When we reach the 0 fib level, coming back to where your fib was initiated from, like that, coming back into that break even of a take profit scaling, going into the 0.27 target, that would be your entry. So I'm overall looking for buys. So if I'm to take this off and we are to go price action 101, we are having, I want to look into the macros. I want to access all the macros that are in the PM session. So we are having the 1:50 to 2 p.m. and I want to read price action in those time windows. I'm having 1:50 to 2:10. That is a macro. So this is a macro. Sorry. $150 to 210. Right there. So this time window is a macro. If I'm to zoom in into that, that is a macro right there. You're having that yellow box as a macro, the 2 p.m. macro right there. So I have this macro dropping lower, taking out a short-term low and coming back into the bullish fair value gap and our breaker on the 1 minute time frame. So this gives you an entry. So the whole macro runs to give you an entry. So this is a manipulation macro which takes out sell side liquidity to start an entry going higher. I'm going to have, this is a bullish breaker block, yeah, just like that. And now this becomes a unicorn model. This becomes a unicorn model. Bullish fair value gap and the breaker will drop into the breaker. So half of this range, close above that, drop back into that, we rally higher, going into liquidity. So that is the 2 p.m. to the 150 to 210 macro. So putting this off, having that, so this macro delivers into the fair value gap and the breaker. So I want to show you that every macro in price has a purpose. Now going into, so this macro sponsors a move that starts a move that takes out a high, and then going into closure of the 2 p.m. candle, you're going to have the 250 to 310 macro, and the 250 to 310 you have an expansion macro. So this was a manipulation macro. I'm going to mark it just like that. In this black and size 14. So that's a manipulation macro, and we are having this. I think I should mark it as this. This would give you better insight. 150 to, I want to show you that every move in the market happens at specific price intervals. Taking this off, that's the 130 I have taken off. Adding test, so this is a manipulation. Manipulation macro. Enter. So this is 150 to 210. Let me fix an image, media center, vertical. What the fuck is that? This is the manipulation macro from 150 to 210. Now this is the 250. This is 250 to 310, and this is an expansion macro. As you can see, I'm going to be talking to you about the expansion macro right there. Has to be, I want this vertical, just like that. This is fucked up. Okay, this is the 250 to 310 expansion macro. So from the 250 to 310, we have the market expanding, going into higher prices. So the macro starts, we drop lower, taking out minor sell side, we rally higher, we have a tiny volume imbalance right there and a tiny gap. The market retests into that, taking out that candle's low, then we rally higher, we form a fair value gap. Now everything in this price, you do not want this. If this is to be an expansion macro, you just want the PDRs to be left open, or the market to work into the upper halves of those fair value gaps. I'm having this as my bullish fair value gap. Market gives you an institutional order flow entry, draw will drop into that, stay above the upper quadrant, then we rally higher. So this giving you an expansion macro. Now the 3 p.m. is kind of somewhat funny because we have, it doesn't do the 50 to 10. We have different macros in this. So after 310, we have another macro that starts at 315 to, let's say 315 right there to 345. So looking into 345, and I expect this to deliver into higher prices. So this 315 315 to 345 gives you a move into buy side liquidity. So I expect this 315 to 345 to deliver higher prices. I'm having my buy side liquidity at that. We drop lower into this order block right there. I'm having a bullish order block at that was printed in the 250 to 310 macro. This is a bullish order block right there. The market comes at the open of the 315, taps that, then we rally higher, forming a new order block, but that order block has a wick, so this is a mitigation block right there, because the market created a high and then ran away from that. So coming back above that, I would want to consider the wick as this macro's entry. So we have the market closing above half of this week. We trade above that week, then a drop lower into the 0.25. I don't know whether you can see this. So the market gives you more entries, coming back into that again and again, sponsoring a move going higher. So we formulate this as a propulsion block, this candle right there, this black candle that first taps into the wick. So this is a propulsion block right there. I don't think I have a propulsion block anywhere in, yeah. So this is a propulsion block right there. Expect this candle to give us a move going into liquidity, to attack liquidity. So a propulsion block is an order block that forms prior to a liquidity sweep and sponsors that move that takes out liquidity. So after we rally above that, remember we'll have the daily wick top at that liquidity right there. The market uses that as resistance to push price, as support to push price high. So we close above that, drop lower, coming into the 345. Now going into the close, I'm looking at the 350 to 357. This is so fun. 350 to 357. 357, I expect the market to run from that going into 4 p.m. the market closure. So this 350 to 357 is supposed to formulate a model for you. Then after 357, the market should give you a last run with speed into the close. So 350 we manipulate, coming back into the top of the daily wick. Then after 350 going into 357, we rally higher going into 4 market closure, and the rest of the day is consolidation. So those are the macros in the. So now this, starting from 3 p.m, this is the final hour trading. So are trading the final hours of the day, which is the 3 p.m. That's why we have a lot going around in that. So even that we have time when we have macros of 3 minutes. So 357 to 4, I'm expecting the market to run into my liquidity that I'm expecting the market to reach at going into the closure. So the rest after that is consolidation going into the close, and I think that is it for the PM session. So that's how we tackle with the PM session from the 1:30 to the 4 p.m. You're going to have this for your trading, those macros. And my goal was, how far can the market go above this? Where did the rally start from? That low going into that high. Related high and low. have to make that. So the market fails to reach that going into the close, and we happen to consolidate. Okay, so that is it for the PM session trading. You need to have these timestamps on your chart. You're having the 1:30, which is the start of the PM session and the end of the lunch macro. You have the 150 to 210. We have the 250 to 310, the 350 to 345. Then you have the 350 to 357. Then you're having the 357 to 4. Those are the timestamps you have to have on your chart for the PM session trading. Okay, I think that is it. Thank you for turning up. Let me have a screenshot of this before we close. Thank you. Have a good day.